We're joined in studio by Roger Williams. He's Managing Director at Centaur Asset Management, and we're talking about their top holdings in their Centaur Flexible Fund. I'm going to take a step back and say, can you give us a philosophy, very briefly, about the Centaur Flexible Fund?
The Flexible Fund is a high-risk investment, and the strategy is very focused, really choosing the best stocks, only about 20 stocks in the fund, looking for exceptional returns. It's returned over 19% since it started 7 years ago. And also I'm looking to manage the drawdown. So active asset allocation, if I see a big market move, a crash, I'll look to reduce equity exposure dramatically to preserve capital.
And in that reduction of equity exposure, you could obviously you could go to 100% cash if you really thought that the end of the world was coming.
Yes. On equity exposure, I look at the interest rate cycle very carefully because that is a leading indicator of where equities are going. Most market crashes are preceded by a rising interest rate cycle, and that's really my leading indicator. So if I see interest rates heading up
in quick succession.
In quick succession, it depends how quick and how much. But the previous crash was really preceded by a 5.5% rise in interest rates, and normally with a lag, the market falls in that environment.
Roger, when you look at your fund, I mean, it's done very well, specifically in the last while. Banks and financials have done you proud. Now, I mean, everyone was extolling the virtues of how cheap banking and financial shares were, and as we've said a few times, they've done extremely well. Yes. What now? Because they don't look, to me, they don't look that cheap. Probably not time to sell yet, but what do you do now? I mean, you've got big RMI. RMI has shot the lights out, quite frankly. It's done extremely well. Outsurance doesn't look badly valued, but you know, maybe Discovery, maybe it's looking a bit expensive now. What would you do with financials now? I'm
not really, you know, I look at each company specifically, and the portfolio is basically chosen on a bottom-up basis largely. And financials is a very broad category. I think banks and something like Outsurance are completely different businesses, even though they're both financials. I agree with you. I don't think banks are of very great value. I think the cycle is looking good for them. Advances growth is accelerating and bad debts are still coming down. But I can't really get excited about banks. My banking exposure is really about 4% in the fund, and that's focused on FirstRand, which I think is really got the best management in the sector. But on others, things like Outsurance, I think it's an exceptional business with great cash flow, and I think even though it's performed so well, I think
still hold it.
I think it's a good long-term investment.
You must be excited about it. 9.8%.
Yeah, it's a big
RMI is it is your biggest holding, isn't it?
Yeah, it's over 11 because it's performed so well.
Run, yeah.
And look at him smiling there.
Yeah,
He's really enjoying this performance on the financial side.
Good performance. Now, I mean, what would you expect to get from the fund in real returns over time? I mean, you've done well since inception, but you know, what would it's probably higher than long term, what you could expect reasonably long term. So what's your sort of, I don't know, I mean, I know it's not an absolute return fund, but what would you think would be, what performance would you be satisfied with over a 5-year period, let's say?
With this level, I think after fees on a net basis, if I could do 15, 16%, I think I'd be happy with that. I don't anticipate exceptional returns over the next 5 years. Interest rates are very low, so that's not a great area to be. So I think 15% would outperform by about 3 or 4% my benchmark, and I'll be happy with that.
And how are you finding the market now? Are people more interested in buying some unit trusts and doing investing? Is there a bit more excitement around? What do you think?
Yes, there is. I've seen a lot of inflows, and people before they're inquiring and not putting up their money. There's a lot of money flowing in, and they want in. I think the low interest rates have really focused them, and they say, listen, I need to get my money working. And they also see the market going, and that makes them more optimistic. The trouble is there's not many individual opportunities. The value's been arbitraged out. Like RMI, I bought it 12 Rand, but it's
I
not.
remember you saying buy RMI at 12 Rand, 17.25 at the moment. Again, the smile.
But now, when you look at your fund, two things stand out. Very low on resources. What do you think of the valuations on that? And then secondly, very little overseas. Well, compared to other players. I mean, you have got something overseas.
Yeah, I think resources, first of all, I look at things from a fundamental perspective. I think resources are above average risk businesses. The reason why is they're price takers, and their price can drop 30% in a month, and that makes your earnings extremely volatile. As we saw in 2009, there were massive crashes in their earnings, almost from record profits down 50% plus. They do look cheap, but I think you have to have a higher discount rate on them. And the trouble with them is there's really kind of like an earnings decay. Their costs are going up faster than their revenue, and then the government is also siphoning away extra profits through greater taxes. So I don't see a great long-term growth profile. So I'm actually steering clear of resources, even though they do look quite cheap. I'd rather be in a high-quality company that can increase prices or has more power.
Coronation, before we go, we're running out of time. Tell me about Coronation, because that's also a big holding. 4.8%, has that also increased substantially because of superb performance?
Yeah, you see, I also let my winners ride. I think Coronation's a very well-managed business, a nice, simple business with exceptional cash flow, and really has grown very well. The trouble with Coronation is that it's very reliant on the market. If the market crashes, Coronation will, it's a high beta stock. But I think it's still fairly priced and still got a dividend yield over 7%, so I'm willing to hold it at this stage.
Are you willing to buy any more at 27.85 rand?
I'd be reluctant. Probably at 25 I may top up, but 27.85 I'm a holder.